Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my good friend, Charlie Dobens. Hi, Charlie.
Hello, Michael. Thank you for having me back, and I appreciate you getting all dressed up for this occasion. I can, see it. Yeah. Yes.
Thank you so much.
Yes.
I working from home in this crazy world, it's actually fun to put on a jacket once in a while.
Your wife thinks you have a date or something. That's a problem.
No, it's business casual. It's only on top looks like this, and the bottom.
Oh, okay.
You look around, whatever works for you.
And the thing is, I wore a nice pair of shoes just for you, and no one's gonna ever see it. So,
but thank you.
Yes.
How have you been? Thank you for coming back. You're repeat.
Very well.
Yes. What's been happening in personal life? Anything new?
Oh man, I tell you, I just got back from my piano lesson, and I'm flying my plane, and I'm doing a little bit of development. I'm having a blast. Somebody asked me the other day, I said, "What?" I was on a podcast. Guy says, "What are you looking forward to?" I said, "The future." I said, "I got so much going on. I can't wait. It's gonna be a blast." So
You're living the life to the fullest.
Exactly. But you always remember what the first fatality of 9/11 of the firefighters was. They consider it was the chaplain when he got hit by falling debris from the tower, one of the towers. And when they were doing his eulogy, they said, one of his favorite sayings was, "You want to make God laugh? Tell him what you're going to do tomorrow." And you know what? I'm looking forward to the future, but whatever God gives me, I'll be happy with it. So.
Yeah, that's a great wisdom. That is a great way to live your life. You surrender to the higher power, surrender to the God, but you're gonna make him laugh by saying what you're gonna do tomorrow. So
exactly.
That's awesome. Thank you for sharing that.
Sure.
Let's talk a little bit about multifamily. You are the multifamily attorney. This is what you do. You live and breathe multifamily. So what's been happening with multifamily? Anything new? What's the latest and greatest in multifamily world in the United States today?
One of the things I'm seeing people do, and you deal with a lot of these investors, a lot of these syndicators. Some of them are very wet behind the ears. They haven't been through a full cycle yet. They haven't, really experienced life. And so I'm seeing, people still having these rose-colored glasses that are telling the world's just going to continue to go up and the cap rates are going to continue to compress, even though Powell and the Fed have just told us, hey, interest rates are going up. You deal with it. Interest rates are going up. And that's going to have a serious impact on a lot of these deals that people are proposing. I tell you, I'm one of the sharks on Cornelius Cannon's Shark Pool event. And, I see some people come up and their projections for multifamily, their deals are just, they're irreconcilable. You look at them like it can't happen that way. We can't, you can't sit around and think to yourself that, this is different than the last time we had a spike. No, they're all the same. And I'm just waiting for it. I'm waiting for the things to turn. I had Ivy Zellman on one of my podcasts, and she basically said we're overbuilt right now, which blew me away when she said that, because we're just seeing incredible demand for our product. And so, where is the overbuilt? Why? How can we be overbuilt when we're at 99% occupancy? And she went through the numbers, and it was tough to argue against her. And she says we've already peaked, and we're starting the downturn right now. And I kind of believe it. I mean, I remember this time last time, and Mike, you and I are old enough to remember that last time. And, I see a lot of the similarities, some differences, but a lot of similarities between now and back then.
Yeah, that's an interesting commentary that things have begun to slow down, and we don't yet know exactly how things will play out. But at least what I've observed, the 30-year Treasury moved 70 basis points, 7.0%, 0.7% from March 1st until we're recording this on March 30th, roughly. And I didn't check what the market did today, but it's a very substantial move. And what the basic observation is if your payment was on a multifamily complex or a single family residential, your payment was $50,000 a month. Now it's $60,000 a month. It moved a lot. The payment factor moved quite a lot, because that 70 basis points on a relative basis is a very substantial move. So the most folks, at least what I'm hearing right now, they're beginning to quickly, at least the smart ones, reflect that in their underwriting and in their negotiations, trying to get a better cap rate, a higher cap rate to pay, because their interest rates are going up, and that's the natural reaction, is that the impact is immediate. You don't have time to raise rents. As much as your value add strategy has rent increases, but it takes time. But the interest rate increase is immediate. You feel it. If you're refinancing, or you bought the property today, you're feeling it today. What are your quick thoughts on what can folks do in the immediate reaction to rapidly raising interest rates?
Tell you, when I see the naivete of some of these people, like, oh, no, don't worry about it. We're getting a fixed rate mortgage. No. You're missing the point here. The point is not that you're locking in your interest rate. The point is that your future customer, the one that's going to buy your property, is going to be living in a different environment that you're living in right now. And he's going to have to account for that in the value of his purchase price to you. And therefore, what you thought you were going to sell it for, you won't be able to achieve that. And the thing is, so what you need to do is, when you're thinking about building your exit strategy, your investment strategy, you got to take into consideration higher interest rates. You're going to bump up that cap rate. Your exit cap rate is going to be much higher than what you've probably been underwriting for in the past. And the rents, you might not see that rent growth that every year, like 3% every year, because sometimes, if Ivy Zellman is right and there's a glut of homes on the market, that's going to impact multifamily owners as well. And so, we might not be able to get those 20% rent increases we've seen in some of these primary markets over the last 2 to 3 years. So you've got to rein it in. And here's the thing is, Paul Moore, who has been on my podcast a couple of times, fantastic guy. He wrote a blog post for Bigger Pockets, and basically he said that smart real estate investors buy based upon the success of their efforts, not in the hopes that the market is going to make the property more valuable. They always say you expect the market to hurt your profits, not to help your profits. If it helps your profits, great. But you make sure your strategy is set up so it's based upon your abilities as an owner operator of the property, and not based upon what the market's going to do. And that's why we see people, the best deals are the value add deals, and no broker involved type deals.
Yeah, it makes total sense. Paul is a great friend. I know him really well, and he's a smart cat. He's absolutely smart cat.
The guy, when he speaks, I listen. I think the guy, everything he said, especially in that blog post, everything he says, I could not agree with more. He was spot on with that discussion.
Yeah, it makes total sense. I mean, we just did a large multifamily deal, closed literally on Monday, and it's heavily dependent on the value add strategy. It doesn't matter what the market will do. Ability to increase rents is a function of the operator executing on the renovations, improving the units. If the market supports it today, you're not projecting it's going to support it tomorrow. Does the market support higher rents? This is your classic value add. But I'm in agreement, especially in this market, you have to prepare and project that the market may correct, and that's the reality. So let's go back. So what's the story to investors today? What do you tell investors? It's an important business today to deliver the right message. You don't want to overpromise and underdeliver. At the same time, folks that are bringing these deals forward, if they don't paint an attractive picture, it becomes more of a, how do you sell the deal? So in this environment with the rising interest rates, then it's not clear how fast it's going to go and how much. We're going to watch meeting by meeting, and it's not just the Fed. It's often the market is a wave and ahead of the Fed. The market is controlling what the long-term rates are going to look like. It's not necessarily the Fed setting the tone. We already know the tone. The tone is going to be going up, but the market is going to respond. So what do you think is the story? What's the right message to investors? How do you get them to basically continue to invest, not turn off the faucet and sit on cash? How do you continue to invest, but you do it in a more realistic expectations manner?
Give them the opportunity to diversify. I've seen that, the different funds coming out now where you're able to put your money into a fund that actually is diversified over several different properties, which is a great investment strategy to begin with. Multifamily is still always going to be a strong investment. The barriers to entry to get into this business, to build new stock, is very high. I saw a great quote the other day that said, if the auto manufacturers had the burdens that we real estate developers have, they would build nothing but Cadillacs, and nobody would get an opportunity for a Chevy. And the point that they're making is the fact that the government has put such burdens on us that we can't build inexpensive homes anymore. We have to build expensive homes. We have to build Cadillacs because the government has made it so hard for us. So that's why the barriers to entries is there for us. So therefore, our product will always continue to be in high demand. As far as where it is in the marketplace, or whether it's going to grow as fast as we thought it was, it's going to continue to grow. Maybe not as fast, but it's always going to be a rising number. And then the other thing too is you got to take into consideration inflation. Multifamily is a hard asset. That's real estate. That's, they're not making any more land. So that makes, if you see the inflation starting to rear its ugly head, you want to put some of your assets into an inflationary, inflation-proof asset like multifamily. And that's what what we're seeing now is we're starting to see some more stupid money going into multifamily, like hedge fund money going into multifamily and real estate, because it's a hedge against inflation. And that's what they're looking for.
Yeah, it's a great commentary. This is really bizarre times from the point of view that the interest rates are rising, but there is still very substantial capital chasing deals. So the projections for the inflows of the capital, and multifamily is one of the largest asset classes that benefits, is still very substantial inflows because the capital's got to get deployed, and it is a great hedge against inflation. And the other point you brought forward is hard to build affordable today. Everybody builds higher end. That's the Cadillacs of housing. So affordable stuff continues to be in short supply, high demand, and projects that focus on more of affordable type of. Affordable doesn't mean that area. It just means affordable relative to the expensive stuff. So right. Affordable workforce housing still has a ton of opportunity, and that makes total sense. So what's the right type of deal selection besides the fact that you want to work in a little bit more affordable range? Because affordable could mean you could be in a Class D neighborhood, Class D area, or Class C, which you don't want to be in either. So it's what kind of what's the ideal asset class? Is it a B product, just more of an affordable pricing? Where's the sweet spot today? What do you see happening in this year? What kind of deals?
All right, so I'm looking to build up here where I am now, which is in New England and up in New Hampshire. Okay, I'm looking at deals, existing assets all over the country. I looked at a deal in Tallahassee. We were involved in it for a while. We couldn't get the financing to work out the right way. But let me go back to what you're talking about, workforce housing here, and just to tie up what you're mentioning. So I got a lead on a great urban lot, and I could build 24 units on this particular in-city lot. And I was thinking about workforce housing. Let me try to do workforce housing. That way they're going to give me like a little bit of a bump, like a 12% bump on my the number of units I can add to it. That'll make it more valuable. Okay, great. Mike, when you sat down there and you did the numbers and you looked to see what type of rents you could get for market, and then maybe, take 25% of the units and make it workforce housing, and you add up all of those numbers, That gives you your gross revenue. You knock off a 5% vacancy rate. You'd multiply by, let's say, a 50%, maybe a 40% expense ratio. That gives you the NOI of that 24-unit property that I was looking to build. You divide it by the cap rate in that particular marketplace, maybe 5.5% cap rate, and it gives you a valuation, a back of the cocktail napkin valuation on that property on day one. You take what a 2-bedroom, 2-bath condo in that marketplace times 24 units, and you compare the valuation of the market for a market rate apartment complex and versus 24 condos, it just doesn't make any sense.
Who wins? I'm curious. Who wins? The multifamily?
The condo by a factor of 2.
So it's more profitable to build and sell these condos than multifamily housing.
Yeah.
Round up.
Yeah. Yep. That's why it goes back to what I was saying about the car manufacturer. The government has put such burdens on it that we don't have a say. I can only build 24 units. That's all the zoning is going to allow me. That's all the government lets me do. And so therefore I'm going to sell them. I'm going to sell them and I'm going to walk away, and I'm not going to be an apartment owner. So that's part of the problem is trying to get these things to pencil out as apartments, as new construction. And it's tough to do. It's tough to do. So,
yeah, it's very hard to do that. I would agree with you. And at least I'm in New York and I'm observing the same thing. They're building condos. You just don't.
Yeah.
There are some new ground up multifamily straight from the start construction, but they're usually sort of unique properties, and you could count probably one of those for every 50 condo initiatives.
Okay, but Mike, let me ask you something. How I bet in those properties that you're talking about, the ones that are being turned into rentals, there's some type of government involvement in them, either like special financing from the government or something that the government has had to give that developer a break on in order to make the numbers work. LIHTC, tax credit or what have you. That's the only way. In other words, government, don't get in my way and become partners with me. Leave me alone. Just let me go out there and build what I want at what should be a market rate cost. But they don't do it. They don't do it. They think they're helping the world.
Well, yeah, in cities like New York, there's a lot of regulation, and for sure, a lot of the new construction projects are required to have a certain percentage of units affordable. And but the government incentive is the only way to go. I'm working right now on a project. I don't know if it's going to go, but it's we're working on in Maryland. And we're getting substantial federal and state tax credits, and without it, and even some city incentives, some grants, because without it, the numbers don't work.
Exactly.
The numbers just don't work. And we're talking about redeveloping an old retail building into multifamily housing. And one of the biggest challenges, and I'll tell you this, and I'd love to hear your thoughts. So we've been working on this project. It took a long time to get those credits approved. As you know, it's a process, right? We got the credits approved. It's wonderful. Now, one of the biggest challenges, we started scoping the project a while back. And now the numbers move so much that everything has to get re-scoped, have to get rebid. Everything, you can't use the old numbers because the old numbers are from 6 to 12 months ago. They're drastically different now. So what are you seeing? Are you seeing any of this stuff being a continuous problem? Because it still feels like supply chain is still a problem. And the inflation continues the cost inflation is just still ravaging. And these projects, when you start the project, by the time you're done, you spend so much more money. So you have to over budget it. And you hope and prayers that the rents have kept up and you can actually charge more for these units when you're done.
Yeah, no, you're absolutely right. I mean, I just had a student come to me with a deal. It's a nice looking deal. It's about a 65 unit deal, but it also comes with 22 acres. And he told me, he said, and they've already been permitted. They've already been approved. And my question to him was, how long ago? How long ago did they get approved? Because if it's over a certain amount of time, he's got to go through the re-permitting process all over again, because the government only gives you a certain amount of time to build. And then you got to start the process all over again. And so now, like you said, we were hearing about the high cost of construction before there was even a supply chain issue. And so that's reared its ugly head. And then the supply chain issue came up, and then COVID came up, and then trying to find people. I mean, I kind of really did a deep dive into modular construction and how they could have these things, put together within 3 days. They build it off site, they come in, they set them, and you're all set. And I talked to my sales rep from the modular company the other day, and he said that we can't even give a guy a cost anymore, because by the time we get it on all set up and ready to build, the cost has gone up 20%, and that's what they're looking at now.
Yeah, it's along the same lines. I spoke with another project development. They're called manufactured homes. It's the same concept. It's like modular homes, manufactured homes. You can't even get the orders through. The wait time to get the orders is very long, and you can't get a price either, but by the time they get to be working on your order, the numbers are drastically higher. It's another interesting thing that I know a number of folks who build to rent. They basically build communities of single-family residential built to rent. One of the biggest problems for investors, and this is back to the investor conversation, how do you serve investors? Is when investors sign up to buy the home, they can't get a fixed price. It's a cost plus, but that cost continues to evolve. So most investors, they're nervous, because in essence, you on a picture today, you say yes to $200,000 per unit construction. By the time you're done, it's $280,000, and folks say, I didn't sign up for this. I didn't sign up for that kind of increase. But it becomes a little bit of a challenge for folks who bring new product to the market. How do you get the right story to the investors?
And one of the modular homes companies that I was looking at, I really liked them because it was like in-house financing. They would do hard money loan on the deal. I would just have put my 20% down, and they would build it. Not anymore. And I said to the guy, why not? He goes, it's too risky. The prices go up too fast. We can't take on that risk of the additional cost. We have to shift it back on a consumer and let that cost increase be his problem. I'm like, ooh, wow, okay, all right, that's tough. That stinks.
Yeah, that's back to the cost plus. Nobody does anything other than cost plus. If you hear somebody gives you a fixed price, I mean, I'd worry about that, because they give you a fixed price, but then you can't get them to perform.
Exactly, because they're like, whoops, we probably shouldn't have given that Slotnick guy a cost plus contract.
Yeah, that's the reality today. You have to be very realistic about what the picture is going to look like. If you're going to sign up for a fixed cost, you're setting yourself a situation where the project will just take forever, because they won't finish it at the cost that they. But this is one of the oldest tricks and the worst tricks when you're working with construction people. I don't know what's been your experience, but the folks I've seen is they start the project, they do, when the prices increase, they come back to you and they tell you, hey, it costs more now. We can't do it at a lower price. You either pay more. If you say, no, I have a contract, they disappear. They just don't show up. They go work on other projects and say, listen, you don't want to pay more? No problem. Go sue us, right? The project ain't going to go anywhere. We are not going to do the work. Have a nice day.
Yeah. And we always said, what was said last time, some of my students are getting the hardest time getting callbacks from brokers, because okay, they don't know them, they haven't worked with them before, and the broker's like, all the broker has to do in today's market is throw up an offering memorandum, and they get 20 bids, crazy numbers. You're getting crazy 1031 money coming into the deal. You got California investors just looking to invest in anything. So the brokers don't have to work all that hard. One guy said, you know what? I remember days like this. Last time this happened, the broker wouldn't even call me back. Then the market crashed, and the best, all I had to do to get a hold of my broker was say, hey, I need another round. And he came right over to take my order. And they'll be working for you down at the country club after this, when everything changes. I've already seen it before. So.
Yeah. Well, then the next question, what do you do now? You sit there and you wait for a correction. You sit there and you wait for a recession. Some folks here is just kind of my view of the world. As much as people may think things will slow down and recession is coming. I'm not necessarily a massive supporter of an immediate recession. In fact, I think the recession does take some time to kick in after economic data starts pointing out. And one thing that I watch, and I'm sure you follow too, is the yield curve inversion. Yield curve hasn't inverted yet, and until it inverts, you're not going to convince me the recession is coming. The fact that the interest rates are going up, it's basically a reflection that there is a strong inflation. It doesn't necessarily mean that recession is coming. So how do you act today? Do you still look for deals? Do you continue to invest? Finding quality deals is hard. It's like you said, there's so many people bidding on these properties, and there's still massive disbalance of what people are willing to pay for them. So do you sit on your hands, wait a little bit, start accumulating some dry powder, or what do you do as a multifamily investor?
There's no shame in sitting on the sidelines and waiting. It does. If you don't find that good deal, don't do it. You know, it's sometimes it's a red flag when people are doing deals that just don't pencil out. If you were to do them on your own, and you know they're doing it for the transactional cost or transactional income that they're going to earn. In other words, they're going to make an acquisition fee. It's a lousy investment. I wouldn't put my money in, but they get paid at the closing table. When that happens, they're not investors. They are brokers. That's all they are. They brokered your investment dollars to get into that deal so they could get paid at the end of the day. I see that more and more. It scares the daylights out of me. Listen, the best deals I have told my students to do are the ones I told them not to do. In other words, sit in the sidelines. This is not a good deal. There are always deals to be made, no matter what's going on in the marketplace. You just have to look harder for them. And the two things that I look for, the type of deals that I get into, are true value add deals, where we're truly seeing some huge spread in the rental income. That's number one. And typically they are owner deals where we are dealing directly with the owner of the property, no broker involved. When they bring in a broker, it just becomes a feeding frenzy. They go full retail, and that's not a good deal. So I'm looking for those types of deals where we're dealing directly with the owner, where they may have built these properties 20 years ago. They're not good managers, and there's a huge play in those types of properties. They're hard to find, I guarantee it. But man, when you find them, that's the millionaire maker. And as like Paul Moore said, don't count on the market to make your investment strategy work. Find those deals that you can do on your own back and make the money yourself.
Yeah, it makes total sense. Let's shift the conversation a little bit to the folks you serve. So you serve investors, you serve the operators. Just talk a little bit about, just give you an opportunity to a little promote yourself.
Sure.
Not that you need the promotion, but how would folks reach out to you, and what do you do for them? How do you help them?
All right. So my entire focus, I started out, as a multifamily investor, and then the market crashed. I lost some of my property. I kept my properties. I still own and operate many multifamily properties. But what happened was I noticed that a lot of my friends were contacting me, asking me to represent them through the process of them losing their property. And, I looked at some of these deals, and there's nothing I could do for them. I just held their hand through the process. But what I came to the realization was some of these deals were bad deals. Why'd you get into these deals in the first place? And they start telling me, oh, well, I'm going to do this. And, we're going to do the RUB system, and we're going to, shift over all these expenses. And none of that was ever going to happen. They didn't know what they were doing. And I thought, man, they needed me before they bought the property, not afterwards. And that's when I really started getting into mentoring and helping people for the last 10 years. And as a lawyer, I tell all my students, I'm a lawyer. I'm not your lawyer. You're going to hire a lawyer, but you're going to work with me. And I'm going to look, act, and feel like an attorney the whole process. I'm going to work with your local counsel to make sure that they do everything correctly. But I'm going to be looking over your shoulder every step of the way. No student of mine sends out an offer drafts a purchase and sale agreement until I've had a chance to review it and make sure everything is right. And then I take them through the whole entire process. I look over their shoulder. I help them with the key principles. I help them with the earnest money deposits. I do all of that stuff to help my students get across the finish line. And that's become my passion for the last 10 years. I absolutely love doing it. It's a blast. It gets me to come running into the office every morning, Mike. It's so much fun.
Yeah, makes great sense, and that's a great service for both investors who invest in these deals, because you're shielding them from some of these stupid deals, and you're helping the students so that they have your experienced eyes to look over the deal and give them some guidance, more like a coach rather than an attorney who just says this PPM needs to look this way or that way, which I think is more valuable to give coaching feedback than a pure legal advice.
When I was buying my properties, all different parts of the country, I hired some great attorneys, and they wrote some fantastic contracts, and they closed the deal, closed escrow, did a fantastic job. But not one of those lawyers could tell me if my deal was a good deal or not. They
don't necessarily. Either they don't care or they don't know. It's hard to find an attorney who is an expert in both finding a good deal and making sure the deal is penciled well and legally properly structured.
Exactly. Yep. So
great. Thank you for your feedback. Thank you for your wisdom. How would folks get a hold of you? What's your website?
My new program, multifamilyos.com, multifamily operating system, multifamily operating system. It's multifamilyos.com, and it's really geared towards helping you build a multifamily business, not just evaluate the investment, but to build the business all around the whole structure, so I can get you to 1,000 units, which is what everybody wants to do. So I'm there for you.
Multifamilyos.com.
Yeah.
Thank you for your wisdom. Thank you for sharing. Appreciate you. And we'll do this again. As I like to say, all good things unfortunately come to an end. So does this interview.
Well, I appreciate it too, Mike. It's always good to see you.
Likewise. Thank you, Charlie.
Thanks, man.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.